All right, good morning, everybody. Welcome to Loan Officer Breakfast Club, Thursday, August 28th, 2025. Mr. Owen Lee in the house. That's going to be pretty cool. By the way, Chris Johnstone's got some really weird, crazy stuff he's going to talk about tomorrow, just so you know. I asked him what it was going to be, and it was like a paragraph long. So I know there's listings in it. I know there's appointments in it. You know, I know there's good things in it, and that'll be tomorrow. But today, we got Mr. Owen Lee. We also have Ryan Whitfield in the house. It's good to see Ryan. It's been a minute. Yeah. Let's see. Who else can we pick on? Ron Smith is with us. Good to see Ron. We got Rod Cameron.
David Bolton.
Yeah. Of course, we have Francis P. Never try to attempt that one, even though I did get it right at least twice. It's on the record.
There's this guy whose name's appearing in a cell on the third. I've never heard of him before. It says Carl White.
Carl White.
I don't know. You ever heard of that guy? Never heard of him.
You know,
he must be a shady character if he won't even show his face. So that's all I'm saying.
Yeah.
It's probably an AI bot that Chris made. That's my suspicion.
Probably true.
That's my suspicion. Yeah.
Strangely, slightly more handsome than the real Carl. If that's possible.
Probably.
Mm-hmm.
Yeah. Some people say, "Well, that's a 10-year-old picture." Frankly, my 10-year-old didn't look any better.
All right. Well, good morning, everybody. Glad to have you here. We do have Owen with us in the house. We'll get kind of jumping into that in just a few minutes. There's a news story I want to show people. Okay. Me and Gen Z talked about it this morning. We actually wound up almost crying a couple of times because then she shared a neat story, and neat stories. That's what we're going to do this morning. So that's the theme here for the first thing. So check this out. So in the news today, the LBC News. There's some good stuff in there, of course, like data points and things like that and all that stuff. But this story stood out to me. There's this gentleman. His name was Richard or Dick Reitz. He was a landlord in Wisconsin for years, and he passed away. And but when he passed away, he had 10 rental properties, and he donated it to homelessness, basically 20 doors. Wow. You know what I mean? And kind of a neat thing. It's like in this business, we just don't know who we're helping, and we don't know who they're going to help. You know what I mean? Carl, you bring this kind of stuff up all the time. We do this for various reasons, but I just, I thought it was a neat story that this guy, worked hard all his life and had a legacy going, and went ahead and donated that to some people that needed it. When he passed away, I just thought it was cool. I thought it was a cool story. So, what else? Oh, in Miami, get this. And 50% of houses that are over $1 million are paid with in cash in Miami. Wow. Miami. I'm wondering where that cash is coming from.
and they have a strange.
I wasn't going to say it.
And the cash has a strange white powder.
I'm just saying, in rolled up $100 bills.
And rolled up $100 bills.
Yeah,
but like straws.
Yeah. So half of them, 50% cash over $1 million.
There's a lot of money down there. Miami is a classic town where it's got incredible wealth, and it's got incredible
diversity. It's
well, I don't mean that poor, like poor, like a poor. It's got incredible wealth, and it's got incredible poor. So it's
interesting.
If I could jump in, being from Miami, this is David.
Yeah, David.
Years ago, it was all about bikinis and cruise ships, and in the last 5 years, now it's technology and finance.
Really interesting. Yeah.
Yep.
A lot of money down there.
Apple, Microsoft, hedge funds.
Yeah. Carl, you spent much time in Miami? I've only been there like twice.
Oh yeah.
Yeah.
Yeah. It's you got to know your way around there. Like any big city, you got to know your way around. But it definitely has some interesting areas. I mean, in a good way. Yeah. And dude, the Keys. Have you been down? You spent any time in the Keys, Frank?
I've never been to the Keys. I've heard all about it. People have said we got to go, all that kind of stuff. I've never been there.
Paradise on Earth.
Mm-hmm. Yeah,
absolutely.
I've never
paradise. Yeah.
Can you buy a house in the Keys? They got housing, or is it all resort?
Oh,
Is
no,
it
no. There's plenty of
like
houses.
you can live there?
Oh, you
In
could,
the,
dude, you could live on Duval Street in Key West, which is the main drag.
yeah.
Yeah, I mean, yeah, absolutely. There's houses there. They're
Huh.
cool, man. The classic Key West style house, right? It's
Yeah.
very, very cool.
Yeah. Okay. Cool.
The only bad thing about the Keys is when a storm comes, there's one road in and there's
And
one
one
road
road
out,
out.
and that's a
Yeah.
problem, and that is a
Yeah.
problem.
All
Yeah.
right. Yeah. Cool.
Anyway,
Hey, well, Zillow research, they're basically saying, affordability is abounding, right? Because of various things, and especially with rates getting a little better.
but not for the loan officers making their calls.
That's right.
Not for the loan officers making their calls.
And there's
Money abounds.
money abounds. I saw this also in Scotsman Guide, who I love Scotsman. I like
good guys.
MPA Mag too. They're both
they're
really
good
great
guys.
reporting on the news and the industry. But yeah, I guess there's this the Hispanic Organization of Mortgage Experts is rolling out special training for Spanish speaking loan officers. So if y'all are in that category, they've got some special training for you guys that's going on right now.
Dude, have you heard about the new AirPods that's
You're excited to
getting ready to come out?
Here's
Where
that's Shawande. Yeah.
you can
Does it translate?
yeah, I put them in my ear, and somebody can speak Spanish, and it translates it live,
Shut up.
and it'll translate back to them, but they'd have to have a pair end also, of course, you know.
Right.
But yeah, you can have AirPod to AirPod. I have a live conversation.
Pretty soon it'll just be the chip in the head, and we can just
Chip in the head. I think a thought, and you hear it.
and I hear it. And it'll be,
Yeah.
how dare you?
Yeah.
That's what's going to be going on. And then of course
are
I had to
weird.
put this in. This is chocolate salami.
Of course it is.
Yeah.
Two
Chocolate
healthy
salami.
things. It's kind
Yeah.
of like a bowl of apples and oranges. Two healthy things put in one box.
Exactly.
So,
Yeah.
Salami
It's
and
I
chocolate.
saw that and I went chocolate salami, and I was like, okay. So I threw that in there. Why not?
I thought you were going to say pumpkin
It's like
spice.
sometimes I put a little kale on my broccoli.
yeah.
All right. Well, there you go. That's the news for the day. I just wanted to get that out there. And don't forget to subscribe. I'll put the link in the chat. You can always just go to loanofficerbreakfastclub.com. And at the top, there's in the news, and you can subscribe. I'm having a lot of fun putting that together. And I know I've said that a million times, but I do. I like it. It's fun. It's interesting. Sometimes it's a little dry. I got to tell you.
I wouldn't say that. I think it's pretty good, man.
Sometimes, but yeah. Anyways,
I
good
like the
stuff.
newsletter. You send out good newsletter. Mr. Johnstone sends out a good newsletter. I love
Yeah,
the man. It's like the old Reader's Digest. For those of you old enough to know what that is, or you just kind of get a little
Snippet.
little snippets, right? It's like give me the headlines in a couple, like one paragraph, not the whole.
Yeah.
I don't need the whole thing, just like good
Yeah.
information. So yeah.
Yeah. Good stuff. If you're getting value from this already, go ahead and tap that like button. It helps more loan officers find content that actually makes a difference. And hey, if staying ahead of the market and learning what's really working in our industry matters to you, hit that subscribe button and ring that bell so you don't miss another episode. We read every comment, so drop your thoughts down below. We'd love to hear from you and know what's working or what you'd like us to cover next. Thanks for tuning in, and we'll catch you here next time. All right. Well, hey, guys, I say we just get right to it. The mortgage market update with Mr. Owen Lee. And we're starting a couple minutes early because word is he's got 7 slides. So,
I do.
this is going to be a lot to digest.
Big day.
Mm-hmm.
I do have a lot of news this morning. There's a lot going on. We're going to talk a little bit about rates, and then we're going to talk about what is going on with Fannie and Freddie.
Yeah.
And so anyway, let's just get, a quick market update. This is pretty well the month of August, going back to say, really it's about a 6-week chart, really. We saw the positioning at the previous Fed meeting, and then we kind of took a step back. Then we had our Fed meeting, and then we had Chair Powell in Jacksonville, Wyoming, kind of indicating that, okay, now he might be on board with lowering rates. Then we talked for a couple of weeks right in this space here about how we basically got the benefit of that cut right away. And, we've recovered a little bit last Friday, too. we had that one data point about producer price index being much higher than people thought, but we are riding at the best interest rates of the year right now. So, for those of you calling, for those of you prospecting, for the Call Stars folks, for the Alliance folks, this is your time. And we've talked about it being a series of several sprints, and we are in one of these sprints right now. I've got my fingers crossed that this will be a 200-yard or 200-meter sprint or a 400-meter sprint as opposed to a 100-meter sprint. Because remember, last year, the best race of the year lasted for about 4 days. But we're looking okay. It was actually a big deal that the market recovered from that one data point, because we've been at times where one data point will just make the market skittish. Yeah. So I could not, if you could go to the next slide, Jen, I could not let this week go by without a little bit of commentary on our Fed governor, who allegedly, it's important to use the word allegedly, committed mortgage fraud by claiming 2 primary residences within a 6-week period of time. The thing about this story, it really upsets me, to be totally honest. I've been in this industry for 22 years, and I'm not being political. This isn't left, right, liberal, Democrat, or anything.
However, those libertarians,
No.
But when a governor of the Federal Reserve does not fill out a financial disclosure form correctly, and all the talking heads on business news and regular news have their opinions drawn with whether they sit on the left side of the aisle or the right side of the aisle, what about all of us, the 325 people who are on the front lines of trying to make sure this doesn't happen? I've had several in my time arguments with Fannie and Freddie where they've sent loans back to us where they thought there was occupancy fraud, and whether there was fraud or not, we had to buy the loan back, right? People get hurt by this every day. This is a cost to the industry every day. And the thing that's most upsetting to me is what I haven't heard is that she denied doing it. And it perplexes me. And actually, for those of you that follow me on LinkedIn, I made a LinkedIn post about it, and then I looked at it and I deleted the post before I even posted it, because I just thought, this is going to come across as too political, even though it's not. I just want Fed governors to not commit occupancy fraud on their mortgage applications. This is a real thing. So anyway, if anybody asks you about it, I just really want people to follow the rules. So let's move on. I don't know how many of you saw this about 10 days ago, this AI-generated tweet about MAGA mortgage. I just saw this. I got to admit, I did a double take when I first saw this, but this is a little bit ridiculous. Just in the sense that, so there's a lot of talk in Washington, D.C. right now about Fannie and Freddie and having them be recapitalized and get them out of conservatorship. And if this happens, this will be the biggest event in the mortgage industry since they were put into conservatorship 17 years ago. And I understand the argument. Nobody thought they would be in conservatorship for 17 years on the day they were put into conservatorship. Every major corporation that the government stepped in to help, every bank that took TARP money, General Motors declaring bankruptcy, all those companies are back to private, except for Fannie and Freddie. And part of that is because they produce income for the federal government. But what everybody's talking about is the so-called capital stack. Everybody's talking about how are they going to be funded? What about the IPO? Is the government going to make money on the IPO? Nobody's talking about the rules. Nobody's talking about the effect that it's going to have on mortgages. And that's what we really need to talk about. We're riding at the lowest rates of the year at 6.5. 6.5 is not a low rate. And even if you get away from it, well, it's a low rate depending upon your perspective. I signed my first mortgage at 8 7/8, so I look at 6.5 pretty friendly. But even in 2019, 2018, we were lower than 6.5. To disturb the market at this time could be very difficult because any uncertainty is going to be met with the desire for an increased premium, which means an increased mortgage rate. So let's kind of dive into this a little bit. If we go into the next slide, what is happening? And this is a confusing issue. And you'll see here about, they're always talking about the capital. Here's the Wall Street Journal article that came out about what the value of the companies will be, about what percentage would be sold, about whether or not they'd still operate in conservatorship and they're being recapitalized. And, there's this desire to talk about this and would the government make any money off it? Again, what didn't appear in this article? Any commentary about what the rules would be for the actual mortgages. I don't know how many investor nerds there are out there. I consider myself to be one of them. There's this guy, Bill Ackman, who's very vocal. He's often on CNBC, often on Fox Business. If we can get to the next slide, Jen. He came out with some commentary that was very widely regurgitated about Fannie and Freddie being merged together, which would be horrible. Absolutely horrible. There are differences between Fannie and Freddie. Every one of the 339 of us that are on this call right now know that sometimes you submit a loan to Fannie and it will pass, that won't pass Freddie, and vice versa. Right? That's a real thing. Are we going to lose that into one gigantic monolith? He thinks it'll bring rates down because of the efficiency. That's the goofiest garbage I've ever heard. Right? That just doesn't make any sense at all. And so this is his highlights, and I just simply Googled, does Bill Ackman own any Fannie or Freddie stock? And that he can't do anything with right now because they're in conservatorship. And Jen, if you can get to the next slide. Oh, yes, his hedge fund, Purging Square, owns a significant amount of Fannie and Freddie common stock.
What's the odds of that?
Who would that be good for?
What is the odds?
You know who that'd be good for? Bill Ackman. Okay, not good for the average homeowner, Mr. and Mrs. Homer. I was really disappointed in that take, to be honest, because he has some good takes. He's a very smart man, but that was not one of them. And so anyway, let's just get back. One more slide, Jen, this morning. This is a very condensed version of the 19-page opinion that the MBA has on this issue. And I'm trying to get the MBA to put out something more bullets, more bite-sized, that's a little easier to digest than a 19-page white paper. So I tried to do that here. And basically, we want 3. We want 2 or more. GSEs, I don't see how the third one's that's not even part of the realistic conversation right now. But we need competition in this space. Fannie and Freddie are gigantic buyers of mortgages. For those of you that don't know, banks used to buy and hold all the mortgages. And when recessions hit and people withdrew a lot of their deposits, the banks didn't have money to lend. So the interest rates would go very high because the banks needed a premium on the very little money that they had to lend. They used to call that tight money. And then, so the government created Fannie and Freddie to have gigantic financial corporations that could buy the mortgages from the banks, so the banks could make more mortgages, thus kind of putting a hamper on recessions to make sure they didn't spiral out of control. So we just need sanity in this space. If we want to Get Fannie and Freddie out of conservatorship. I think the industry is all over that conversation. But we need to concentrate less on the capital stack and more on what's going to happen with Mr. and Mrs. America when they go to buy a home. And so anyway, I could talk about this issue for a long time. It's very confusing. You have to, unfortunately, spend a lot of time trying to understand it. But it's important that we engage in this conversation as an industry, because if the folks in Washington and the bondholders and the shareholders just want to get their way about it, it could drive interest rates higher. And that's a real thing. So we've got to be engaged as an industry on this.
Hey, Owen, for the average loan officer, branch manager that might be on here, including myself, like not that anybody here is average, right? But what does it mean to not to me as a homeowner, not to me as my community and what's best for America? Because I know you spend a lot of time working on that, which is why you do your work with the MBA. But like so selfishly for me as the loan officer, do I really care?
Well, that's a really good question. If they do it right, it shouldn't affect you. If they do it right now, the people that buy bonds from Fannie and Freddie because they're in conservatorship feel they have the guarantee of the United States government. That means if the bond goes bad, they'll get paid by the U.S. government.
Mm-hmm.
If they stop believing that, they will want more of a return because their risk is higher. So it's a very confusing issue. If it gets done right, it shouldn't affect loan officers in the street, shouldn't affect borrowers buying homes, shouldn't affect people refinancing homes. If they don't get it right, interest rates, some of the things I've seen could increase by 50 to 100 basis points in rates. And if we woke up in the morning and rates were 7.5 instead of 6.5, which is kind of where they're hovering right now, that would be a huge issue for everybody on this call.
I see. So it's kind of like everybody's investing into them now in the bond market because of the backing of the government, which certainly feels secure, right, at some level, right? Secure, as opposed to it being an individual company. It could be like Sears or Kmart or any of these. I was watching a thing last night about.
Could be like buying, big corporations issue bonds every day as a way of raising money. Like a Home Depot. I'm just like, pick any big company, right? A bank, U.S. Bank, Wells Fargo. They all issue bonds, and those bonds come with a premium. They bear a higher interest rate than like a Treasury bill, because it's less likely that the U.S. government will default than Home Depot. So the Home Depot's got to have higher rates. Fannie and Freddie bonds would be the same way if they didn't have a guarantee from the federal government. So
very interesting. Yeah, because these big companies, like if you look, I was watching a thing last night on Netflix, and it was all these behemoth companies that were staple industry, like Sears. And like growing up, Kmart was huge.
Yeah.
And there's literally one store left in the United States right now. There's one left. There's one.
I saw a post on X this morning, Carl, you bring that up, and it was a headline from the St. Louis Post-Dispatch in 1960 that said, "Can small Walmart survive against the big guys?"
Yeah.
And the picture of the big guys was a Kmart store.
Yeah. So if you lose that stability of the government, and now it's left up to the the capitalization market. I mean, big companies rise and big companies fall, and that's just the way it is.
So I don't talk about this a ton, even though there's a lot of news, because it is confusing, and there is that thought process, right? Like, why should I care? And the answer is, you shouldn't care if they get it right. I'm just concerned that they're not going to get it right. And if they don't get it right, then we're all going to be affected.
So it's kind of like,
got to pay attention.
It's kind of like the pilot of my plane. As long as it goes right, I don't care. But if it doesn't go right, I really care.
Exactly. Maybe not quite that catastrophic, but yes.
Hey, thanks for enjoying this Loan Officer Breakfast Club YouTube video. If you are into industry news, if you like to keep up with what's going on within the mortgage and real estate industry, you might not be aware of this, but you can get free news snippets every single day by going to loanofficerbreakfastclub.com. In the top nav bar, you'll see in the news. Click it, daily, fresh news about the mortgage and real estate industry. There's even loan officer perspective and realtor perspective on each news story that you can make use of in your marketing. So enjoy loanofficerbreakfastclub.com/in the news.
Hey, Owen. Anyway.
Owen,
yes, sir.
I'm just curious, so they've been in conservatorship, like you said, 17 years, right? But at the end of the day, things are kind of rolling okay. Things are kind of smooth, right? So,
I know.
What's your personal opinion? Should they come out of conservatorship? I'm just curious. Should this be coming to the surface right now?
So this is one of those things where elections have consequences. If we had a Harris administration right now instead of a Trump administration right now, this wouldn't even be a conversation. Do I think I do. I don't want to go through the conversation. I don't want to go through this, but I do think they should come out. I don't think the government should own these entities. They existed as private entities for decades. They did very well, except for one period. I'm for them coming out of conservatorship, but in a smart, planned, and measured way. So,
and keeping them separate. Fannie Freddie, no combined one or anything like that. Just let's get them out of conservatorship in a skillful way, so it doesn't disrupt things, and go from there.
A phrase I learned from a very smart friend of mine named Carl White is, one can be a very scary number.
Yeah.
And I just think show me any large utility-like entity where there's only one where it's efficient.
The post office.
Give me one.
Never mind.
Yeah.
Hey, Owen, let me ask you something. So
Yes, sir.
let's say these two stay separate or combined. Would you personally buy stock in them separately, or would you or combined? Would you buy stock in these organizations?
I would buy stock in them either way, because the easiest way to say it is, it's very difficult for these companies to not make money. Like, they have to really, really screw it up to not make money. They almost always make money, because we forget, right? We're selling a 6.5% rate right now. The actual interest on that mortgage is way higher than 6.5%. because of how it's amortized. Pull a closing package, pull the amortization schedule out, and look at it. If your borrower has a $3,000 payment in the first month, $290 goes to pay the principal, and $2,690 goes to interest. You hold that mortgage for 5 years, the actual interest return to the bank is more like 9% than 6.5%. So we forget about the amortization schedule inside of mortgages. But when a mortgage is not held for 30 years, which almost none of them are, they return an interest rate much higher than the actual note rate that appears on the promissory note.
Fascinating.
Very interesting.
So I would buy stock in
Hey, just real quick, Mr. Gillespie, and then we'll get to Brad, and then Frank will wrap it up. What you got, Kevin?
Well, I was going to ask Owen's opinion. Years ago, Fannie and Freddie were not in receivership, right? They were outside the government, but it was a quasi sponsorship. Isn't the real issue if they lose that sponsorship? Not only will rates go up a little bit because it won't be rated with the full backing, but it'll also affect liquidity quite a bit, will it not?
There was language in
the amount of liquidity for the marketplace, in other words.
Yeah, so what Kevin's referring to is there was language in the congressional acts that created these two companies that implied, not explicit, it didn't say in a sentence, we will back the bonds, but it implied that the U.S. government would back the bonds, which is actually what they did when they put it into conservatorship. So that thought process of the investors that Uncle Sam is going to stand behind these payments, drove the interest rate that the investor demanded lower and was great for the housing market. So a lot of it revolves around, are we going to get the implicit guarantee that we had before conservatorship, or are we going to get an explicit, explicit guarantee, where they just come out and say, yes, we're going to back the bonds? The difficulty right now is when they're in conservatorship, they basically have an explicit guarantee. So the big unknown question is, not to like be a grammar person, but if you go from an explicit guarantee back to an implicit guarantee, how much does that increase the risk, and how much, therefore, does that increase the rate? Nobody knows the answer to that question. Mm-hmm. People can talk about it all day long. They can get on the shows and do this, but the real answer is nobody knows. So that's why they want to do it at a time when interest rates are very low. If interest rates were at 5.5 and the market was humming and they went up to 5.8, no big deal, right? Not really. But if interest rates are at 6.5 and they go back to 7.25, pretty gosh darn big deal.
Hey, Owen, do you have time after this to shoot a quick podcast, go deeper into this? You have time today?
I do.
Okay, cool. I'll meet you. I'll meet you on my link.
Okay, let's get to Brad.
Okay.
Get your hand up, Brad, then we'll try and get on out of here.
Real quick. Back on slide number 6, Owen. There was a statement there about Ackerman and his company, and I'm just wondering if it's an exaggeration. It said hundreds of millions of shares that they own. I mean, how many shares are outstanding for one guy to have hundreds of millions? I'm not a big investor expert, but so there really is. He could really hold hundreds of millions.
Oh, sure.
They say he has 180 million shares.
180 million shares. So I mean,
that's a lot of shares.
I mean, but how many shares exist?
Well, when you think about it, Brad, I'm no Wall Street tycoon.
I'm not either.
These companies were created. Yeah, these companies were created decades ago, right? And so they've had share splits, and they've done 2-for-1s and 3-for-1s. And then when they went into conservatorship, shares were almost useless or almost valueless, the common stock shares. So companies that had a lot of money and a lot of patience, Bill Ackerman, like I don't agree with him on this issue at all, but he's a very smart man, right? So they go and they buy shares that are almost valueless and hang on to them and say, hey, when this thing comes out of conservatorship in 7 years or 11 years or whatever the hell it is, this is going to be like really, really valuable. And that's how he accumulates that much.
That number just seemed, hard to comprehend. That's all.
Hey, Owen, are you familiar with the ETF? ETF. Think of it like a mutual fund for those not familiar with that term. So it's like a mutual fund. Are you familiar with the ETF? And this is not a political statement. This is just a real thing. Are you familiar with the ETF that tracks Nancy Pelosi's investments?
I was just at dinner last night where we had a conversation about this. Yes, I am familiar with it.
Hey, they all say, if can't beat them, join them. So that's one of my ETFs. It's a stock ticker. It's NANC. So like Nancy without the Y, NANC. And whenever she makes a trade, it mirrors that trade. And it's been good. Right?
Well, she's able to outperform everyone.
Yeah.
I was having dinner with some people who I would consider stock nerds, and the consensus was that was a good investment. The only problem with that ETF is that it's delayed because you can't find out exactly what it is until the disclosure comes out.
True.
And and some of these, the thought process is some of this money is made on timing, right?
Yeah, but like in the first day or 2 days,
right?
Mm-hmm. Yeah.
Anyway, it's
financial advice.
Oh man, she is an amazing stock picker. Amazing, isn't it?
It's
uncanny. So they have these ETFs that track government officials. That when they make investments, you can make that same investment. So anyway, just
I bet when her new disclosure comes out, I would bet $100 that she did not buy Cracker Barrel 3 weeks ago.
No, but
oh my God!
I bet she bought it 3 days ago. So.
Yeah, exactly.
All right, let's get out of here. All right, you guys.
Old Uncle Cracker.
Hey, Owen, thank you so much, man. We're always blessed to have you here. Can't thank you enough for showing up on Thursdays, man. Appreciate it. And for the rest of you guys,
start of my week, Thursday morning.
Awesome. Thank you. All right, for the rest of us, let's get after it, my friends. We know what we're doing today. Today is our pre-approved and lookings. If you don't know, consult with the main office. They'll tell you what's going on. You guys have a great day. We'll see you here tomorrow with Chris Johnstone and Amazing AI Madness. Served up to you on a silver platter. We'll see you guys then. Adios.
Hey,
Have
I'm
a
going
good
to
day.
keep this open just for a minute for everyone to get the slides. So.
Oh, got it. Slides are at the house. See y'all. I got to go.
Have a wonderful Thursday, everybody.